Major funding for these broadcasts is made possible by grants from Capital One Bank and Chase Commercial Term Lending, the Witkoff Group, New York Community Bank, M&T Bank, Greenberg Traurig, Perfect Building Maintenance, Genova Burns. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America, Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, CPEX Real Estate Services, Cushman and Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Foley and Lardner, Friedman, Handler Real Estate Organization, HAP Investment Developers, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman, USRealty.com, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Massey Knakal Realty Services, Matone Group, Mercantile Commerce Bank, N.A., Meridian Capital Group, Newmark Grubb Knight Frank, Newbanks, MHP Real Estate Services, Optimum Window Manufacturing Corp., People's United Bank, Rosewood Realty Group, SJP Properties, Sterling National Bank, Sterling Risk, Stonehenge Partners, TD Bank, Terra CRG, the Continuum Company, the CUNY TV Foundation, the Moynihan Group, and these friends.
These prices are insane. That was the pitch line for Crazy Eddie. The only problem is these prices are insane because they're going up, 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 and up. So today, is the market reached its peak? Is there an opportunity to buy a property in New York and in America? Where is the opportunities? So I've assembled this group of investment advisors and owners to talk about where they see the market, or has it reached the peak. My guests today include Aaron Jungreis, who is the chairman and CEO of Rosewood Realty, Chris Schlank, who is the founder and co-managing partner at Savanna, Giacomo Barbieri, who is the head of investments for the U.S. at TIAA-CREF, and last but not least, normally known as the statistician, my buddy Robert Knakal, who is the chairman for New York Investment Sales at Cushman and Wakefield. You have no notes today. I'm very proud. No notes. But I know that it's in there. It's in your head. So you've seen cycles. You've been with me. I've done 754 shows. You've been with me many times over here. Are we at a peak? Is there opportunities out there? Can he buy in this market?
Well, Michael, certainly we're at a peak so far in this cycle, but how high that peak will go is yet to be determined. And if you look at what happened last year, we had more buildings sell in New York than ever before, 5,532.
Okay.
Wait. By the way, Bob did 5,430 of them.
And dollar volume was not quite at the record in 07, but we think the dollar volume will exceed 07 this year. The number of properties sold will be down a little bit, but certainly from a pricing perspective, this market is continuing to run, and we expect that to continue at least through the end of this year and well into next year.
But here is the question. When once in a while, I check statistics with you, and I check, the market of how many deals are being churned because of what we call 1031 tax treatments. Okay? And when I call up my friend, Mr. Jungreis, he says to me, people are buying buildings because they're selling buildings and they don't want to pay taxes. How many people today are buying buildings because of the 1031 exchange rules?
I would say from my deals, probably a quarter are 1031 buyers. But even the guys who aren't buying in 1031s, it's Israeli bond money. A lot of foreigners are coming in. So it's not just that's fueling the market. we're selling more and more, and I'm sure Bob will tell you, to foreigners than ever before. At least I'm doing more foreigners this year than I did last year.
I mean, let's look at two investors, okay? Savanna has been around a number of years, and you've been very active over the last 4 or 5 years, and you were very active in Lower Manhattan, and you went at the right time. There's no question about that. TIAA-CREF has done an enormous amount of business over the last 5 years. I think one of the best deals that you bought was the 3rd Avenue property, that the Pfizer building that nobody looked at, and also the corner over here. How do you, representing your portfolio is what, 80 billion in
82 billion.
82 billion in real estate.
Globally, yeah.
You know, you're still there and you're still bullish. Where do you see the opportunities?
Well, I think the capital market cycle is really fully realized, which means that going forward, I don't think we can expect much in terms of cap rate compression. And but then you have the fundamental cycles that can definitely offer some room for NOI growth. So most of our focus is really towards properties that offer that opportunity.
So what are the properties? I mean, he's looking for those properties, you're looking for those properties, and you're going to these two guys to buy them.
But I think to Giacomo's point, to interrupt, the disconnect is between the cap rate on the existing NOI and the cap rate on the to-be-formed NOI. Right? Giacomo bought 21 Penn from us, and I think we sold it too cheap. And we had a conversation earlier. He's going to make a tremendous amount of money. The rents there on 31st and 8th are very low. So therefore, the cap rate, doesn't matter what you use, if you realize it into a per square foot, it just doesn't compute.
But you know what? In the same way that you just said, you may have sold it too low. You bought.
I'm so happy.
No, I don't think that was the inference.
Okay, no. But I think, but part of the situation is neighborhoods change. Okay, Hudson Yards has changed the nature of 34th Street. Okay, the buildings on 34th Street were $40 a square foot, $35, $40. You know, even the Penn Plaza, they were never. They're $60, $70 because you're near transportation. You have the railroad. You know, when somebody goes there and they say, I got the Long Island Railroad, I have the Port Authority, I have the opportunities over there. Then, you know, there are also the ferries for New Jersey and then the buses. So you're really looking at a market that has great potential.
But, look at Hudson Yards, though. Look at Brookfield Place. That's what's driving the market. I mean, Penn Station's been there forever, and maybe they'll clean it up, maybe they won't. Who knows? You know, Roth and Ross can't figure it out. But what you have is the new. I mean, when I talk about Manhattan, I say that the Manhattan is shifting to the west. Park Avenue, the office people are falling out of Park Avenue to the west. And I think what's happening, and as we all know, is that with Hudson Yards, which is happening finally, and Brookfield Place, which is happening finally, you have really new, nice, LEED-certified, column-free office space that you can't get on Park Avenue. Think about Park Avenue. It offers nothing.
Here's a potential problem in the Hudson Yards West Side. Not talking where you are. I'm talking over there. When you take the extension of the 7,
which no one has.
Right, when you reach that level at the 7, you have like the L train to Williamsburg in certain markets. It's one train, okay? Right. They'll run a couple of them, but it's one train, it's one stop, and that station can get packed. The same problem that happens in Williamsburg, but when you go to the other areas that you go to 6th, 7th, and 8th Avenue, on the 34th Street corridor going to 42nd Street, you have a lot of opportunity.
Much more opportunity.
But but if you tie Penn Station into that, I think you're going to have a pretty good outlet into Midtown West, into Hudson Yards. Right, because people will take the walk for half of the year. So,
what are you seeing with regard to the multifamily in the Hudson Yards or the Chelsea or the Far West Side market?
Everyone I talk to tells me that they're not scared at all about the market peaking because they put out a building for rent, the rents are going up. They have renewals, their rents are going up. They have a line out the door of tenants that want to get in. So I see it only appreciating in value. I don't see any slowdown at all.
What about land? I mean, I remember a couple of years ago, I had your buddy on the show. We were talking about land in Brooklyn at $80 a foot. He says at $80 a foot, the guy who owns the garage is going to keep the property and it's going to be a garage. Brooklyn. Downtown Brooklyn. I went to school there. I remember it. $500 a foot? I mean, that's a little high, isn't it?
And climbing. But, Michael, just to get back to multifamily for a second,
Can't make money at $500
I think
We'll get back to that.
It'll get
Let's
higher
get
than
back to that.
500. But getting back to multifamily for a second, and Giacomo, to address your comment about cap rates can't compress any further, I think there are optimists in the market who believe cap rates can compress further, particularly in the multifamily sector, mainly because we've had two very distinct periods of times in the past where we had negative leverage in the market, where we had cap rates that were below lending rates. That was in the mid-'80s when everything was being converted to co-op. And again in the 05, 06, 07 period where everything was being converted to condo. We have not yet had a period of negative leverage in this cycle. So the optimists will argue that, while as crazy as it sounds, the cap rates could compress even further. And based upon this seemingly insatiable demand that exists, I wouldn't be surprised if you see cap rates compress further, particularly in the multifamily.
But remember,
sector.
they're compressing not because money is cheaper, because it will get more expensive. Cap rates, in my opinion, are compressing because the underlying rents are under market, right? So when we sell buildings sometimes, we say we'll sell it for, instead of a 5 cap, we underwrite a 4 cap or a 4.5 because there's a big pop coming from the office rents, right? You see it coming. If you're selling a building with 40% of the building that has $40 rents in a $70 market, you know that somebody will pay you a lower cap rate because of the pop.
Right, for the opportunity.
So I think when you talk about cap rates, you can't talk about cap rates in a vacuum.
No, but
right?
Chris, you're right. Absolutely. Cap rates are inversely related to upside potential. The more upside there is, the lower the cap will be. But in addition to that, the very acute supply-demand imbalance we have, where there's so much capital chasing so few properties, is exerting so much upward pressure on prices that if you have capital and you want to buy a property, if you're not stretching and paying a low cap rate, you're not buying anything.
Yeah, but to a certain point, if there's not going to be the upside in the end, you're not going to, right? There's a cost of capital
But,
where
certain people are just saying, hey, I can't get money in the, the banks aren't giving me any yields. The stock market has been up and down. It's a different type of thing. Look at this. They are a fiduciary in TIAA-CREF. They have to return. They have all of these people have their pensions with them. They've done a great job. If I want to look back, their first investment was a
Montgomery Ward
building,
nice.
Flushing, and then they bought a building on 44th Street. So they go back to this, and they've been buying since 44, and they want a stability because they want a steady return.
Yeah.
They're not looking for that.
So that,
the big
that was the comment, which is perhaps cap rate compression may continue, but that's not our focus. We're not going to buy assets with the expectation that we're going to be able to gain appreciation through cap rate compression. What we're focusing on is properties that can produce the NOI growth that will create the additional appreciation going forward. And I think, 21 Penn Plaza is a great example. Savanna did a great job repositioning the asset. Bob, I think you got a great price.
we were partners with Files.
It was full.
Remember.
But we still see a lot of value in that asset. If you look at all the money that's being reinvested in the neighborhood, what you'll see is a neighborhood that's very different, in 5-10 years. And we're going to benefit from that, potential rent appreciation.
And you also are different. I mean, you're a fund, and a fund has certain requirements. I remember my days at Apollo, you have to get rid of assets over a period of time. You're an open situation. Yeah. You don't have a rule to get rid of your property in X number of years, correct?
That is correct. And it depends on the fund. We manage for a large number of different funds with different strategies.
But in many cases.
But in most cases, that is absolutely correct. And I would argue, Chris, if you had an open-ended fund, that's probably a property that you would have considered keeping.
I would, yeah. Listen, we're selling everything right now. 1375, 31 Penn, 100 Wall, 21 Penn.
So now
it kills me.
So now
I
go back to my Aaron comment. So you have all this money coming in now. You have to return some to investors, and then you have to deploy it again.
Well, we're not recycling this. This is Fund 2, which is a 2010 vintage. So this money is going to get returned and not recycled. But we're in Fund 4 right now, which we're 50%.
Right, and you have
got to buy
5 or 6 years.
And you got to keep on buying.
So who's buying to you? Who comes to you and Bob these days?
I'll
because
tell you,
I hear this comment that everybody's out there. We know that you're out there. We know that you're buying. We know that we hear the comment the Chinese are here, the Chinese are coming. It's like the old statement.
First of all, I want to answer you before. People's expectations have changed. It used to be 5 cap was like the bottom. Now there are many people who are happy with a 4, even a 3. Some parts of Brooklyn and Manhattan, even in that low 2 range. It's happening today. So you want to know who the guys are? It's foreigners. It's guys that's buying with 1031s, Israeli bond money. All these type of guys are coming in. It's not just 1031 guys. And it's some guys who've been on the sidelines who their grandkids or their kids are getting in the business and they want to buy something and they didn't, and they just want to deploy capital. And they feel that, rents are going to continue to go up.
So here's a question for the investors, and then Bob to answer the question also. When you're looking to buy assets today, because you're looking at similar assets, Chris, I would say that Giacomo is looking at. How hard is it at the bottom line at the end? I mean, how many people are bidding on these deals?
It depends on the type of
I'm
property,
talking
but
about-
generally
Right.
there are dozens of people bidding on everything. And I think to further what Aaron said, the most tangible trend that we've seen in this cycle that's very different from anything I've seen before is the number of first-time buyers that are coming in, not only from around the globe, and they're coming from every corner of the world, but first-time buyers from around the United States that I think have been working really hard in their local markets to try to make yield and make returns. Their returns have not met their expectations, and they look at New York and say, wow, look how great the guys there are doing. I want to get in and get a piece of the Big Apple. And we have a lot of first-time buyers coming in from around the U.S.
We
that
love those
want to buy
guys.
now.
Now, there's this phenomena, called crowdfunding. And since I'm a little older, I remember tax shelters. I remember people around the world saying, I want to own a piece of something. And, the crowdfunding mechanism is, you can buy a piece into this opportunity. And a lot of deals are over there. Do you see crowdfunding as one of the competitors to you?
Who's the guy that just bought two ring buildings today?
Right, that's Nino
Yeah.
from Prodigy. Do you see the crowdfunding people?
I think it's becoming a more significant part of the market, but I think it's still in its infancy and is gaining traction. I think it's something definitely to keep an eye on, but I think that is not something that's at the forefront of the marketplace today.
I don't feel intimidated at all.
Yeah, the question is how big can it get, really? Can it become of the scale that actually makes an impact? And
But
I don't know about the
But the ultimate answer is that when we buy real estate, it's all about underwriting. It's about back of the house. What are you buying? What's the budget? How do you fix it up? And how do you make money? And the people, and I don't want to be politically incorrect, but these people aren't. They're just gathering money to buy things because money is cheap. I mean, we pass on deals all the time because we know too much. And it kills us a little bit, but we know too much. We do too much underwriting. And I would think Giacomo would say, and I don't want to be a self-promoter, but when we sell buildings, the back of the house for us is the best part of the party. Because when these guys go to the back of the house, 21 Penn, yes, maybe, but we spend so much money repositioning what we buy, and we put so much effort and tears and blood into every deal, which is why I said before I hate selling stuff, because we put everything we have into every building, and then unfortunately we have to sell. But for us, the fun part is when the back of the house. Come on, show me.
What about, a number of years ago, a number of companies, Amco came in and bought some multifamily over here. They even bought walk-ups with people who would be surprised. Do you see the REITs coming back over here? I mean, the big names that we hear about every day is, SL Green buying over here. Vornado has not really bought over here. Boston Properties hasn't bought. Do you see the REITs as a big competitor in this market today?
I think definitely. I think more so getting into the residential area and retail. Certainly the REITs are a major force.
Yeah.
The only question I have is their cost of capital, because it seems to me they can only go so far. So as you go up the quality spectrum, it becomes increasingly hard for them to compete. It remains, nevertheless, very competitive.
Where are the opportunities for an investor today? I mean, because, as I heard before, when Chris sold 21 Penn, there was opportunities because the market changed, the world changed over there. Lower Manhattan, when Chris went into a number of the properties down on Wall Street and so on, the world was lower. Today, when somebody is buying a building in Lower Manhattan at $600, $700 a foot, that's not a market, especially when you have the Trade Center competing with that type of property over there. Those are a little difficult to see that big profitability.
Michael, I think there's three areas of great opportunity today in the city. One, just buying well-located properties that you don't over-leverage, because every cycle exceeds the last peak. You're going to do fine with extraordinarily well-located stuff. Secondly, properties that are located near transportation hubs in the outer boroughs. The mayor and subsequent mayors will have to provide affordable housing, workforce housing. The only way to do it really effectively is to increase density around transportation hubs. So property values around those hubs will go up substantially. And then the third area, I think, is office in the outer boroughs. I think if you look at the delta between cap rates in Manhattan office and cap rates on borough office, it's now as much as 200, 250 basis points on the cap rate. There's no way that should be the case. So I think that is an area.
This gentleman over here, I believe, utilizing you, is selling, as I used to always call it.
I like that word, utilizing.
Okay. I called it the proverbial Jolly Green Giant, the city Bank Tower. I remember Citicorp. So you know what? There are discussions. You know, it's a huge office building. It's in great transportation. You couldn't buy better. It was built specifically on the train because at that time nobody wanted to be in Long Island City originally. It was a different market. You know, the repositioning of office. You know, in Long Island City is fine. I'm not certain if office in Williamsburg, you know, where there's a certain level for WeWorks and certain levels. I mean, there's a lot of office market coming around for different types of properties. There's the Jehovah's Witness property, which is, the RFR, Cushman companies. There is, the properties in Long Island City that we spoke about. There's the Hudson Yards. There's Lower Manhattan properties. Okay? There's office, but certain people are looking. Like you bought 837 Washington.
Yeah. So you got to look at it based on who you are as an investor. I think Chris and I have a very different view of what is opportunity. I think you're really driven by return and total returns. We're driven by low volatility and stability of the yield. So for us, something like 21 Penn Plaza made sense because you have a managed rollover, you have a property that's been repositioned with a beautiful back of the house. But you also have the opportunity for growth through rent appreciation. And we capture it. The funny thing is, if you look at the account that it went into, we capture it through appraisal. That account is benchmarked. Its goal is to beat a benchmark. And their assets get appraised routinely on a quarterly basis. So even if we don't have the role to increase the NOI, if the rents in the market are higher, in the discounted cash flow model of the appraisal, that value is recognized, and we recognize it today.
Here's a question. There was a building, I'm not sure who built it, where West Side Market opened up on 3rd Avenue and 11th Street, I believe, or 10th Street. It's a brown brick building. It was acquired by the Kuwaiti Pension Fund,
on East 12th.
On East 12th Street. The rents are over there in excess of $110 a square foot. It's a different neighborhood than the corner on 72nd Street. It's a different market. Sometimes when people are buying a property that has already possibly reached its peak, that's the question that I'm looking at.
Well, that's a cap rate question.
It's a cap rate.
We think about it all the time. When you're buying retail, for instance, when we buy retail and it's vacant and you lease it up at the height of what you think the market is, what is your exit? It can't be a 3 because there's no upside. You're signing a 10 to a 15-year lease. So that's where, for us, we struggle all the time is what is your exit and what is the cost of capital for your buyer? And again, it goes back to what's the credit of the lease. But it's it's complicated.
Right. When you look at retail, and the show that I did the week before, I remember 2001, we didn't have places like Chopped. Okay? Chopped today, retail sales are $1,000 a square foot.
Incredible.
2001, we had a few Starbucks. We didn't have Gregory's. We didn't have 12 other retailers. 2001, we didn't have all of these fancy LMVL and all the other stores over here. The world has changed in retail, and there's always segments. 2001, the Gap was big. The Gap is dead today. It's a different market. So, we don't have the crystal ball, and it's hard. So I'd say I agree with you that retail is a difficult market completely.
I would call it the most dynamic sector in real estate.
Right. Now,
requirements change continuously. And I think that the success within retail is really understanding what the best retailer for a location is, because you're going to be able to charge rents based on their sales.
Exactly.
So it's very possible to actually buy out tenants because you can replace them with better tenants for that particular
You know
location.
what? And relating retail specifically, if we just go back 10 years to 2005, and I would do a show on Madison Avenue, and I had the owners who owned property on Madison Avenue, they said many of the people who went into the retail over there, they were there more as a brand name as opposed to gaining sales. They didn't care about
was
the
advertising.
sales.
It
It was an advertising place. Now those properties at the rents that they're talking about, or the rents in Soho, which when Tony Goldman built, he didn't build these properties that could absorb this market. You know, so we're looking at it's a volatile market.
And
But
yet
the retail
retail
market has changed. It's not about selling hats, jeans, and coats anymore. It's about selling products, right? So if you look at the Googles, the Verizons, all of these big technology companies that are Microsofts, they're the ones that are actually taking over these concept stores. Look at Microsoft, $17 million a year at the old Tommy Hilfiger space on 54th and 5th. There is a revolution in retail, and
awesome.
the revolution is going towards technology and the new way of living, as opposed to the old way of selling jeans.
And a lot of sales have gone onto the internet. And
Yeah.
so retailers really need that point of contact with the customers. And a lot of it is done through eyeballs and fingers in these mega stores, flagship stores, where they get a ton of traffic.
Yeah,
they don't need to make the sales there. They're supported by the internet.
Exactly.
But you know, the interesting thing is that Best Buy has returned doing business as a retailer, even though most of it was competing. But there's a different trend over there. So where do you see the best opportunity with like a minute left? The boroughs? See the Bronx?
Boroughs.
No, Brooklyn is still my favorite borough.
Brooklyn is your favorite borough. You?
Talking about retail properties, I think retail in the best locations is still undervalued. I think you're going to see retail sales on Fifth Avenue at over $50,000 a square foot this year.
You last
I think
point.
it's, for us, it's stick to the knitting, looking for office, retail that's just kind of hurting.
I'll say retail in the financial district.
You like the retail.
Still has a ways to
In the
go.
fin-
So why did you buy 100 Wall?
What's that? It's got a big office on top of it.
Okay, so I'd like to thank Aaron, Chris, Giacomo, and Bob. See you next week.